Welcome to Lazy Learning. In this video, you'll learn 20 must-know finance terms. Asset allocation. An asset is any type of investment that has the potential to earn a profit, such as a stock, bond, exchange-traded fund, mutual fund, or real estate. Asset allocation is the process of allocating your investments in such a way that risk is minimized. This is accomplished by diversifying your portfolio among asset classes that optimize return while minimizing risk. Capital gain, or loss, profit, or return on investment, is referred to as capital gain. For instance, if you purchased a piece of stock for $600 and subsequently sold it for $900, you would have earned a $300 capital gain. A capital loss is calculated similarly. If you purchased a stock for $500 and sold it for $200, your capital loss is $300. Ask, or bid. Occasionally, asset values are expressed in a bid/ask format. The term bid refers to the maximum amount a buyer is ready to pay for an item. The ask price is the cheapest price a seller would accept for an asset. Bull market. Bull markets are those that are growing or moving upward. If you believe the market will rise, you are labeled a bull. If you feel a certain stock will increase in value, you are considered bullish on the stock. Bear market. A bear market is one in which prices are declining or moving downward. This can occur during periods of economic hardship or public crisis and can persist from weeks to years. If you believe the market will decline, you are labeled a bear. This term may also be used to particular stocks, in which you anticipate the price will decline, in which case you would be considered bearish on the stock. Index. An index is used to track the performance of a collection of assets, such as stocks, bonds, and other financial instruments. The Nasdaq 100, the Nasdaq Composite, the S&P 500, and the Dow Jones Industrial Average are just a few of the more well-known indexes. Dividend. Certain businesses provide a portion of their earnings to shareholders in the form of a dividend. Dividends may be paid as a one-time payment, on monthly, yearly, quarterly, or on biannual basis, or may not be paid at all. Margin. When you create a brokerage account to invest in securities, you must select between a cash or margin account. Margin is a term that refers to the practice of investing with borrowed funds. Credit will be extended by the broker, and the entirety of your account will be treated as collateral. The goal is that you may earn a better rate of return on the borrowed money than the broker's margin loan interest rate, resulting in a personal benefit for the investor. EBIT/EBITDA. Earnings before interest and taxes, that is EBIT, and earnings before interest, taxes, depreciation, and amortization, that is EBITDA, are two often used financial terms that refer to a company's earnings before certain expenditures are deducted. The measures are thought to accurately reflect the company's core earnings. Exchange-traded funds, ETFs. An ETF is a type of fund that holds multiple underlying assets, rather than only one like a stock does. As an investor, you may purchase and sell ETF shares in the same way as you would stocks. However, purchasing an ETF offers you partial ownership of a fund of diverse assets, whereas purchasing stocks gives you partial ownership of specific individual companies. Individual retirement account, IRA. An individual retirement account, IRA, is a sort of retirement account that comes in a variety of forms and provides a tax benefit for retirement savings. You may start an IRA as soon as you turn 18, but not all types of IRAs are instantly available. Market capitalization. The market cap of a corporation is the total worth of all of its outstanding shares. The market capitalization of a business is derived by multiplying the current share price by the number of outstanding shares. Price to earnings ratio. A P/E ratio is a financial ratio that indicates the worth of a company in relation to its profits, which are frequently represented in terms of per share earnings. For instance, if a company's stock is selling at $75 per share, and its earnings per share are projected to be $3, the P/E ratio is 25. Share. Stocks, often known as shares, are a percentage of a company's equity. A share's value is determined by how the firm split its stock. With shares comes a share of the company's earnings, or gain in stock price. If the stock price falls, the value of the share will likewise fall. Short selling. Shorting a stock implies borrowing shares and selling them at their present price, with the promise of returning the shares to the lender in the future. The aim is that the stock price will fall, at which point you may purchase the shares to return to your lender, profiting on the difference in price between where you sold and purchased the shares. Rather than that, if the stock price increases, you would incur a loss when you return the shares to the lender. Volatility. Volatility refers to the degree to which the price of a traded item changes or fluctuates over time. Bond. A bond is comparable to a loan, but with several important distinctions. The buyer is the lender in the event of a bond, whereas the seller is the borrower. In general, the bond issuer or seller is a government entity or a business. When they issue the bond, they pledge to return the principal amount, or the amount borrowed, on a certain maturity date in the future. Additionally, they will pay periodic interest to the bond buyer at a rate known as the coupon rate. Hedge fund. A hedge fund, like a mutual fund, is an investment instrument that generates profits by the pooling of money. The distinction between hedge funds and mutual funds is that hedge fund portfolio managers are employees of a corporation, limited partnership or limited liability company that raises money from clients and then manages and invests it across a variety of assets. Mutual fund. A mutual fund is a pooled portfolio of securities that is professionally managed by a portfolio manager. This manager invests in a broad portfolio of assets through the pooled fund. Individual investors contribute to the pooled money by purchasing mutual fund shares. Mutual funds are actively managed, which results in greater costs than investing on your own. Index fund. An index fund is a type of mutual fund that is constructed to replicate the performance of a specific index. For instance, if you invest in a Nasdaq 100 index fund, and the Nasdaq 100 increases in value, the value of your index fund will increase as well. Because these funds are passively managed, the costs will be lower than those associated with investing in a traditional mutual fund. Thanks for watching. Hope you liked the video. Like, subscribe, and share.